So without further ado, I'd like to move on to our next speaker. And I'm going to keep this short, as the man really needs no introduction. A distinguished physician, a veteran of Her Majesty's Army, and certainly one of the best writers that I know. It is my distinct pleasure to welcome to the stage Dr. John H. Watson. Take it away, Dr. Watson.
Did you press it? It's dark up here. So good morning, everyone. I'm Dr. John H. Watson of 221B Baker Street. I was just pretending to be my friend Sherlock earlier. I'm going to tell you an adventure this morning that's never been discussed before, since many of the people involved are still living, and we don't want to disparage anyone. So it started one dark and damp London afternoon. As Sherlock and I sat in our Baker Street flat. I was reading some of our past adventures in back issues of the Strand magazine, one of my favorite pastimes, by the way, and Sherlock was playing the violin. Won't you stop that infernal scratching, Sherlock? I pleaded as Mrs. Hudson burst into the room. There's a gentleman to see you, Mr. Holmes. He had no appointment, but he's in a state of great agitation. And before Sherlock could even answer, we heard the hurried footsteps of a man rushing up the stairs. At that moment, the door flung open. A gentleman burst in, his cheeks red. He was indeed in a state of agitation. Without any word of introduction, not even a good morning or good evening, he almost screamed at Sherlock in an accusatory manner. Gold is at all-time highs, he said. Where are the gold investors? Oh, do calm yourself, my good man, said Holmes. What is it about which you wish to discuss with me? Well, our visitor started. The gold price is at all-time highs. The costs of mining have not gone up anywhere nearly as rapidly as the price of gold, and so the margins have been expanding dramatically. The mining companies are now making money hand over fist. The dollar's collapsing, as I always said it would, he added. And because the cash flow of companies has increased, and because their NAV has increased with the increase in the price of gold, the cash flow and NAV multiples are actually falling. The stocks are cheap. Look at Agnico Eagle, which is the gold standard I understand it's the gold standard of mining companies. Their price to cash flow is well below their historic average and close to its low. Look at Barrick, the second largest gold mining company in the world. On a price to book value, it is trading virtually at its lowest multiple in its entire history. And yet, said our guest, remember, I'm John Watson. And yet, said our guest, US investors are simply ignoring all of this. Here are the flows, I won't say into the GDX, here are the flows out of the GDX. $3.3 billion this year, outflowing from the GDX. Look at the GDXJ. This is the last month. Just a couple of days there with inflows, and then almost 200 billion of outflows in the last month. People are actually taking money out of gold stocks, he said. So I'm John Watson, remember. I mumbled to nobody in particular, well, yes, but the gold stocks are up 55% in the last year. Our guest heard that. He said, yes, but gold stocks normally exhibit leverage to gold, particularly at the beginning of a bull market. Just look at these recent examples. In 2016, gold was up 19%, the stocks were up 124%. And of course, the real juniors, said our guest, not those pseudo-juniors in the GDX Junior Index, the real juniors, they haven't moved at all for 3 years. Mr. Holmes, said our guest, I beg you to find the missing gold investors. Well, you're remarkably well informed, said Sherlock. Now, I know your sterling reputation as an economist, of course, but your intimate knowledge of the gold sector, well, that is quite remarkable. Our visitor, uncharacteristically, declaimed credit. Well, I got this from the manager of my gold fund, he said, Mr. Adrian Day, a very well-informed gold investor. That's John Watson, I mumbled, well, if he's so clever, why isn't he here? Well, our visitor had indeed presented us with a mystery. Gold was up, margins were up, the gold stocks were cheap, and yet North American investors were selling. Sherlock, come on, Sherlock. I think the game's afoot. Let's go and solve this gentleman's case, I said as I put on my hat and coat. Oh, you go on, said Sherlock. I can solve this case sitting right here in my armchair. Oh, okay, said John. That's me, I said. Well, I'm on the way to the London Reading Library, to confirm our visitor's facts that he apparently got from this Adrian Day fellow. So here I am, leaving 221B. It seems I forgot my coat. But I thought on the way to the London Reading Room, I would stop off at the Diogenes Club. You know who we find in the Diogenes Club, don't you? That's Sherlock's brother, Mycroft. Mycroft is equally, if not even more intelligent than my friend. He has worked for the government in many, many different departments, and he obviously has contacts everywhere around the world. You know, the Queen usually asks his opinion before she makes a major decision. It's often said that he doesn't simply work for the government, he is the government. So in I went to the Diogenes Club. Good morning, Mycroft, and thank you. Oh, I've mysteriously found my coat. Good morning, Mycroft, thank you for seeing me. So I explained to him the problem that we had, and he addressed it. You know, my sources, said Mycroft, inside government, tell me that central banks of the world are buying gold like they've never bought gold before. This is to diversify their assets in the face of dollar weaponization. and nothing has changed with the new administration. My sources in Asia tell me that non-official investors in China have been also buying gold at a dramatic rate. And they're worried about a devaluation of the yuan amid a falling economy, fragile banking system. They're not allowed to buy Bitcoin, so they're putting their money into gold. In addition, said Mycroft, wealthy families in the Middle East and Asia, as well as in Europe, well, they're worried about the fiscal situation, not just of the United States of America, but of all countries around the world. And so they're turning to gold as a defense against what might happen when governments address this fiscal situation. Well, I said, that all makes sense. Thank you very much for seeing me, Mycroft, I said as I bade farewell. So give my regards to Sherlock, won't you? Well, after quickly visiting the London Reading Library, this gentleman had confirmed everything. I didn't really need to go there. I returned to our flat, and I found Sherlock smoking his confounded pipe, sitting calmly in his chair with another visitor, the clueless Inspector Lestrade, looking even more clueless than ever. So I excitedly retold what I had discovered and confirmed my visitor's analysis, the one he apparently got from this Adrian Day fellow. Sherlock, Lestrade addressed him. Sherlock, I've been looking into this case now for a long time. I can't find any clues. Sherlock, where are the gold investors? And Sherlock replied, elementary, my dear Watson. As Mycroft told you, the central banks and the Chinese are buying gold for their own particular and peculiar reasons. Typically, North American investors turn to gold when the economic environment is conducive to gold. Now, for the last several years, the US has had a strong economy, a strong labor market, high interest rates, low and falling inflation, and until this year, a strong dollar. That is precisely the wrong environment for investing in gold. And then when you add to it that the S&P as well as the TSX in Canada, when you look at that they've been going up month after month after month, well, I ask you, why should any normal investor turn to gold or gold stocks? It's actually perfectly logical, said Sherlock, that they haven't. And then there was a pause. Moriarty is behind this, Watson. Oh, here he goes again, said Lestrade. Moriarty. Surely, Sherlock, even you don't believe that Moriarty is responsible for all this. Well, Holmes' mind drifted to the last time that he had seen Moriarty. Yes, Moriarty and his evil gang, known as the Federal Reserve. That's the outfit behind every major crime in London. He and his gang control interest rates and they counterfeit money. So for many years, this gang flooded the market with counterfeit money. That caused asset prices to move up artificially. It caused people to borrow more than they should borrow. And we had an artificial boom. Then he suddenly dramatically raised interest rates, risking the economy as well as the stock market. What he is doing to interest rates now, stubbornly refusing to lower them, even though they are well above their natural rate, he's keeping investors away from gold. I thought that all makes sense, even though I didn't really understand what he was talking about. Well, the next evening, our visitor, our client, came around again. Why does Sherlock always look so smug? I told our visitor, our client, what we had found out, what Sherlock's analysis was. I also told him that Holmes thought that the Federal Reserve gang was behind everything. Well, that seemed to cause our visitor to chuckle. I guess he doesn't like this Federal Reserve gang. But when will investors ever return to gold stocks? Patience, cautioned Holmes, a commodity that it appears our client lacks. Ah, yes. As I've told you many, many times, Watson, historically investors have allocated between 2 and 4% to gold, and now they hold less than 0.5% on average in gold. Nearly 80% of investment advisors, registered investment advisors, say they have less than 1% in gold, and most of those have 0. Look at family offices, who are often actually at the forefront, at the cutting edge of new investments. Well, if you squint, you might be able to see the gold allocation there, but you have to look carefully. It's just under 1%. And yet, when it becomes clear that the economy is slowing, the dollar is falling, interest rates have to fall because of a weakening economy and the government debt. And when it's clear that inflation is not under control and is slowly moving up, well above the Fed's arbitrary target, well above where it was before COVID. And lastly, as we head towards the end of the summer and we head towards the debt financing crisis of the US government, when, said Sherlock, I believe the Federal Reserve gang will turn to quantitative easing again. They've already stopped quantitative tightening. Then that will be wildly bullish for gold. And when the S&P wobbles and some of the leading stocks fall, then some of that money will start flowing, that money will start flowing into other assets. And much of that will go to Europe and foreign stocks and emerging markets and value stocks and dividend stocks. But some of it, said Sherlock, will flow into commodity and gold stocks. When you consider that the market capitalization, the market value, I won't say the value, but the market value of just the five largest tech stocks in the United States is 67 times as great as that of the top 5 gold mining companies, and indeed about 25 times the market cap of every single gold stock in the world, including even the tiny exploration companies. Well, it will take only a tiny amount, a very small amount of that 15 trillion and more to flow into gold stocks for that to have a dramatic impact on the prices. We have seen this before. In the 1970s, gold stocks up 1,300%. In the 2000s, they quintupled. After the credit crisis, in just 2 years, they almost quadrupled. And of course, those graphs that I showed are only for the senior stocks. Some of the juniors, of course, did much, 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 much better. And, said Sherlock, there are actually indications that regular investors, retail investors as they're sometimes called, are actually returning to the space. When you see silver doing as well as gold, and when you see the junior index doing as well as the senior index, that is a sign that retail investors are returning to this space. All we need is just a little more patience. And so I think we have found where the missing gold investors are hiding out, and we have found when they will be coming back to our sector. Our mystery is solved. And disclosure before I go, any words attributed to any characters in this tale are purely fictitious. Thank you.
Dr. Watson, thank you for that splendid presentation. Would you be willing to take a couple questions from the crowd, Dr. Watson?
Of course.
I think there is more to discuss.
I don't know if I can answer them. Let me get on my phone to this Adrian Day character.
Absolutely.
Okay.
Welcome back, Adrian Day. So I can start with one question, and then maybe we can field a couple from the audience. The first is that I would argue that the central bank buying that we've seen over the past 3 years has been the backbone of this move that we've seen in gold. Going back to 2022, 2023, 2024, we saw more cumulative purchases by central banks going all the way back to 1950 in each of those 3 years. And I'm wondering what, if anything, do you think would reverse that trend?
No, that's an excellent question. I think it will reverse, or it'll certainly slow down in a natural way of its just own accord. Meaning when a central bank thinks that they have enough gold in their reserves and they have few enough dollars in their reserves not to really need to aggressively sell dollars and buy gold. You know, this is a long-term trend, you know, and I always remind people that this is something that certainly preceded the inauguration of President Trump in January. You know, at the end of 1999, so at the beginning of this century, central banks around the world, in aggregate, had about 78% of their total foreign reserves meaning not the pound for the British bank, not the Swiss franc for the Swiss National Bank, and so on. They had about 78% of their foreign reserves in the dollar. 5 years ago, it was down to about 65%. Now, this year, it's actually gone under 50%. It's now around 47.5%. So the decline has been a long-term decline, and it's also been accelerating dramatically recently, and it's also been very, very dramatic. Now, there are some countries, like Russia, for example, which is already out of dollars, but some countries like Russia that will want to get out of dollars completely. But most countries don't want to get out completely. They just want to reduce them significantly. So I think it'll just happen of its own accord. But when you look at averages, of course, you know, that can be very, very misleading. And so there are still a lot of countries that are very underweight gold. So I think there's years to go. Let me just finish by saying, when you ask the question, what will cause that to change? I mean, as I said, this is a very, very long-term trend, very long-term. But nothing that has happened this year under the current administration would make any country anywhere in the world willingly stop selling dollars and buying gold. I mean, is Brazil going to say 100% tariffs? Oh my gosh, I'm so sorry, President. We were just messing around. Let's buy some treasuries. We'll sell all our gold and buy treasuries. Of course not. Of course not. It'll, in fact, have the opposite effect.
Wonderful. I'd like to offer them.
Okay, I have a question back here. With all the money that's being, I don't know what the proper word is, expatriated by these governments back to Europe in particular, what is that saying to you, or what are you hearing that would be clear for us?
I didn't quite hear the last. What is that saying?
With all of the gold that is being taken back to home countries, is there a message in what's happening?
Yeah, no, that's a good question. I mean, we do have these periods, as you know, from time to time when various countries start repatriating gold back to their own country. I mean, I don't think there's anything specific in people's minds. I think it's just a matter of when there is, let's say, chaos and uncertainty, and I think it's fair to say this year has been, we've seen chaos and uncertainty. You simply want your wealth more readily available. So I think there might be some, I don't think there's a specific immediate concern, but there's maybe a concern, well, if my gold's in New York, I mean, if I fall out with the US, are they going to confiscate my gold? I don't know, so let's bring it back home. You know, it's just, I think it's a natural, I think it's a natural reaction.
Questions from the audience? Got one up here.
Good morning, Adrian. Is Basel III really ever going to take effect for U.S. banks to really take gold seriously?
Yeah, I think so. Part of that, but all these things go slowly, right? I mean, U.S. banks, U.S. Financial system generally has not really appreciated gold, not really regarded gold as a real asset, as a respectable asset in the way that, say, European banks in particular and Asian people generally have regarded gold. We haven't had really the sort of recent experience that some of these countries have had in seeing the value of gold. And so when you haven't really regarded something in any particular light for a long period of time, it takes a long time to turn it around. But I think what's happening now with the SLR, with the reserves, and the Federal Reserve saying, and Treasury telling the banks that they don't need to hold so much on reserve, on deposit at the Fed in their reserves, and of course the bill from Senator Cruz not to pay interest on reserves held at the Fed anymore, which incidentally was the way it was before 2008. He's not really doing anything dramatically radical. But I think if you're telling people you don't need to hold so many treasuries on reserves, maybe that's a nudge, maybe towards buying some gold. I don't mean they're deliberately nudging, but maybe it just incrementally. I think it'll come, but it'll come, but it'll come slowly because we haven't had the sort of experience that Germany or France or Italy or much of Europe has had in recent past. I don't know if that answers the question.
Thank you very much for that, Adrian. Can we please have another round of applause for our presenter? Thank you.